Hello everyone, welcome to 9fin's webinar, No Country for Old CDS. I'm Dan Alderson, an editor at 9fin. I'm so happy you can join us today. Now, CDS events are never without surprises, and we've got a very nice one for you today. We're joined by not just 3 CIOs, but 4. And I will go through the rounds now and allow you to introduce yourselves. So please can I start with Orlando?
Hi, Orlando Gemes. I'm the founder and CIO of Fourier Asset Management. We're an emerging hedge fund that focuses on convertible arbitrage. I've been trading CDS since 2004.
Let's pass to Clark.
Good afternoon. For me, I'm founder and CIO of Aucit Investment Management. It's a long-short European credit strategy focused on short duration, high yield on its longs and hedging via CDS, TRS, and various indexes. And I was on the Institute Determination Committee for about 4 years, and at one stage ran a long-short pure CDS fund of about 500 million for a few years.
Thank you. And to Mark.
Hi, Mark Rieder. I'm a CIO of Lamar Assets, focused on fundamental credit. I'm also a senior advisor for Fourier Asset Management and author of the book Reminiscences of a Bond Operator, a guide to investing in corporate debt, which was published by KDP Press last year.
Great. And last but not least, we are joined by a special guest, Nick. Please, can you?
Yes, thank you. I'm Nick Pappas, CIO of Faros Point Capital. We are an opportunistic credit fund focused on European credit.
Brilliant. Okay, so we're all here today to talk about the state of the CDS market and the changing role and perception of this product. I think we all agree it's a sort of new era, given aggressive LMEs, restructurings, deliverables disappearing, that sort of thing. And so I'm very lucky to be joined by such distinguished guests that all have a long track record of experience in this market. So I think that perhaps we should, not to give like the whole sort of 101 on the CDS asset class, but we probably should give a sort of catch up for people who maybe it's not their first asset class, or they've found themselves in this situation with restructurings and want to learn more. So I guess as a conceptual thing, people think of CDS as an insurance product sometimes, and that is only really a small part of the picture. It may have begun that way with banks in the 90s trying to offload some of their risk, but it's quickly evolved into a flow trading product because it's very nicely aligned in theory with the returns you get on bonds. So it became a way of synthetically having that exposure to bonds without needing to hold them or source them. And that's why it grew and grew in the early 2000s, right up to the financial crisis, where, as we know, they became a part of the sort of synthetic CDO landscape in the subprime crisis. That's without saying, I think the corporate CDS actually emerged from the financial crisis fairly unscathed, except by perhaps reputation and association. But since that point, I guess we've seen a gradual evolution of the credit landscape. And now there's another use for CDS, which is a sort of more perhaps unknown or hidden use of it, which is to be a big part of these restructuring, these debt negotiations. And that's in itself may be a big lever for people in that situation who are very savvy at playing in CDS, but it's also arguably at the detriment of the flow trading product and of the hedge that it was originally intended as. So maybe, Orlando, I'll start with you actually. Maybe we can dive into what should the CDS market be in theory and where are we now? How is it changing?
So we've seen a rapid expansion in the growth of the credit markets over the last decade, with an increased domination of ETFs and indices. I think concurrently, we've seen a really changing landscape in the leverage finance, high yield and restructuring market, with the proliferation of liability management exercises from the private capital markets into public credit and from the US and into Europe. For single name credit default swaps, in the event of the default, the seller of protection becomes liable for the difference between the face value of the obligations and their recovery value. However, in order to determine that, and as Dan is very much an expert on, we have to go through an auction process that involves only a limited number of parties who all have maybe vested interest in the outcome. And we're seeing real ramifications for that in the single name CDS market. So in 2020, we had 19 credit events that resulted in a CDS auction. That has fallen to just 2 in 2024 and 2025, and it's led to some quite obscure outcomes like Europcar. So we have to ask the question, is it a coincidence that the number of credit default events has fallen significantly at a time when LMEs have rapidly proliferated? And at the same time, we also need to look at the single name CDS documentation and recognise that it hasn't been updated since 2014. So while LMEs have progressed significantly, expanded, the range of technology, as people refer to it, has increased and spread, as we've seen sponsor on creditor violence, creditor on creditor violence, and we have seen a very much a changing landscape. The documentation for CDS has not changed.
Great. I think we can all remember a time, this is probably going back to pre-crisis, but also for a time afterwards. But CDS was a very versatile product. You could use it. It obviously had indices, there's tranches, options. There were relative value strategies you could do flow-wise. You could do bond versus CDS. You could do skew trades where it's like the index versus the underlying instruments. Nick, you're very versed in this market. What have you seen and where do you think things are at the moment?
Look, when I look at the market going back to pre-crisis, as you mentioned, the single name market in Europe is in CDS is now approximately a tenth of what it was at the highs. So we've seen CDS continually not work. And when I say not work, what I mean by that is someone buys an insurance policy on theft or flood or whatever it is, and the insurance policy then doesn't pay out, but you've spent money on this. And then, so the policy not working, meaning you buy CDS plus you buy a bond or you own a credit, the package of those two combined should track somewhere around par. And what we're seeing is quite the opposite. Now, if we go back to 2014 in the SNS default, we saw bonds trade down to 5 cents and then CDS, your insurance policy, roll off worthless. Now, the definitions were changed for financials back then post that event, but were not updated for corporates. So I think the issue we continually see, if someone wants to hedge and be prudent and take risk off by using CDS, they're actually potentially adding risk on both sides, which makes the product more and more difficult to use. Ultimately, when there's a reference obligation or a credit the CDS is referencing, however that obligation morphs, whether it's debt, it's a secured debt trading at 40 cents, that should be deliverable as it economically initially existed into the product. And what we're finding is flaws, as we've mentioned, in the product that are causing dead boxes. Dead box meaning there's suddenly no deliverable on CDS. And it hasn't changed. So if anything, each event, we see a lot of short-termism, who's on what side, how are they going to win? And that's fine. Look at the letter of the law. But as each of these things happen, and people say they're never going to use CDS again, they do use it, but they use it less and less. And I think that's one of the main reasons the product has, at this much smaller new normal, 1/10 of pre-crisis.
I'm happy to jump in a little bit on that too. Just to mention, I mean, there is traditionally a rationale or reason for being, and yes, it is this, let's call it insurance. But some of the specific aspects where CDS really worked were it's limited cash outlay typically. Often you can get a more maturities, like there's a 1 year, 10 year sometimes, but certainly 1 and 5 are very common. So if you've got a bond of a 3 year maturity, but you want to have a 1 year exposure of 5, it gives you that opportunity. Also, it isolates credit risk very nicely. So in that sense, although you can do as a basis trades and various other things, it is actually independent of most other market aspects. If that credit goes wider per se, the CDS goes. And I mean, there is, depending on which jurisdiction you are, often you can do a CDS in a certain currency that gives you coverage or exposure to a credit of a different currency, which is nice, particularly if those are very emerging markets. And traditionally, it certainly has been more liquid, and it still is more liquid on the index side. But yeah, I absolutely agree that yes, it is 90% down in volumes relative to the GFC, which is 20 years ago almost now, certainly 18 years ago. And interestingly enough, that had grown within the 10 years before, 100-fold. So it's only a fairly new market. And I think one of the points of this discussion is the meat of it, there is value there, but it seems the mechanisms are failing as the market develops. And I think we're looking at a few things there. But yeah, certainly default to pay is pretty clear. Bankruptcy is pretty clear. But this whole restructuring area is where there's a real, I think, a failure in the mechanism where you're looking for insurance, you're looking for CDS to actually deliver if there's what most people would view as a default, but there's just no deliverables.
So given the restructuring element of this, are we seeing a difference between Europe and the US here in some ways? Mark, you're maybe in a position to give a perspective on that side of things.
Yeah, look, I think the question we're all asking here is if your house burns down and the insurance company is not being prompt in paying, haggles over its value, is it worth buying the insurance contract? And who gets to decide how much that you get back? I think you have two different markets in the US and in Europe. Both of them have seen the volumes down significantly, but in the US, you've seen it down even more. And I think that when you have these events of restructuring, the debt boxes, the LMEs, you're trying to figure out, can I put a package together where I can either protect myself, whether I can do capital structure arbitrage, and ultimately, can I understand the bankruptcy code and the order of events and the priority of claims and be able to either protect myself or trade it? And I think that's becoming a lot more complicated here.
But I would add that as much as we've all traded global credit, and as much as we look at the two markets, really, part of the nuance is that Europe cannot be considered one consistent market. Though we trade in euros, you really need to have intimate knowledge of the legal and regulatory and the bankruptcy code in each of the different jurisdictions that you trade. And that knowledge is not easily passed, it's not fungible. And then there are incredible inconsistencies even between the application of the law. So litigation can be difficult and expensive and very unpredictable even in the US, but once we move into Europe and the UK, it really becomes much more complex. And this is where the nexus kind of joins us between CDS and LMEs, of that there really is a close relationship. And obviously with the credit events that we're starting to see in Altice and Ardagh that we've traded for well over a decade, we're starting to see how that manifests itself.
On
Yeah.
Orlando's point of the nuance of the different jurisdictions, that's the crux of the issue with European CDS and why it's different. In the US, very simple. We have Chapter 11, we have Chapter 7, we have fail to pay, and you have restructuring credit event. In Europe, you've got Sauvegarde in France, you've got Concordato in Italy, you've got Concurso in Spain, scheme of arrangement in the UK, and the timing of when these triggers actually occur, let's say in the UK, the filing of the scheme in the court, by the day that happens, if the deliverable is gone, we have a dead box. And I think that overlay is what really can create opportunity and is interesting, again, if you've done the legal work, but it's also scaring away the buyers, the insurance buyers of CDS. And that's the crux of the issue. There's no one to sell CDS to if the shorts don't want to buy it. And I think there is a very good need for this product. As I mentioned earlier, bond deals are tiny in Europe. Your typical high yield issuance is 500 million. That's hard to borrow, hard to short, a lot of variability in the borrow. So CDS should be a great product and needed from the short side to hedge, but as long as it works.
Yeah, I think before we go on to the Altice, but I just wanted to point out, I read some great research this week from Zaya actually on the basis packages of CDS versus bonds. And I think that was a good follow-up for people who want to look at that, how that's breaking down and how it's not going to par. But yeah, moving on to Altice, actually, before we do that as well, if anyone has questions for the end, please send them in. We'll try to address them depending on how much time we have left. So let's move on to Altice, because this is like the first big test of this year, really, if we don't count interim, which was a overspill from last year. So Altice was a pretty interesting situation that kind of was rumbling on since kind of March last year, I think, when they asked creditors to take a sacrifice basically in order for them to use the assets they were moving into unrestricted assets that they weren't going to use to pay down the leverage. Less creditors took sacrifice. So that's where things started with Altice. Quickly got sort of people trying to work out their position in the structure and various groups emerging to deal with that situation. And it took until May 2025, the end of May this year, to see a trigger for CDS, which was the accelerated safeguard process that it entered into. Now that presented an immediate problem for the EMEA Determinations Committee, because 95% of bonds were locked up either by by the lockups or by co-op agreements. And yeah, we took 3 months to get to a CDS auction, which has happened. And during that process, there was a lot of discussion by the DC. You can see all the updates on their website, how many meetings they had. And they trialed a sort of untested proposal by ISDA to deal with lockups. Ultimately, they decided not to use that because Altice announced that they were going ahead with the restructuring, and the deadline for transferring bonds was going to be 9th of September, i.e. yesterday. And that left a very sort of accelerated timeline. So they then went to an asset package delivery approach. Now, I think perhaps it's a case of all's well that ends well, or all right on the night, because the CDS auction returned a result of 87.75. That was in line with where bonds were. But there's a very small open interest, and the limit orders were dominated by one bank. So maybe also we can talk about the amount of time it took to get there. But Nick, maybe you've got a good view on this. What do you see as what went well with this, and what have we learned from it?
Look, I think what went well, when I mentioned earlier the package of the original credit asset, and in this case, the asset class the CDS reference was secured debt. So thus the much higher recovery because the secured's recovered there. So as far as the package getting to par, CDS minus the debt, you're within a couple of points of par on either side, depending on which deliverable it is. Now, so I think that went well. What didn't go well is the fact that it took so long to get there, and there was debate around locked up paper. Now, this is a huge structure, and you had a very large percentage of a secured debt class in this cooperation agreement, which is partially why the recovery outcome of the actual debt was reasonable versus what we see in a default and in a restructuring like that. But yeah, it took a while, and there were concerns around, can we deliver locked up paper? Can we deliver equity? And in this case, luckily, the debt hadn't detached from the equity, so there was still a debt-like instrument to deliver. So that sort of protected it, unlike in the case, Ardagh is still TBD, we don't know, but in the case of Ardagh, according to the current restructuring plan, there won't be a debt-like instrument, everything's converted to equity. So that's where I see Altice SFR working versus Ardagh potentially not working. Now, if I look at Altice International, different entity, the CDS package right now trades around 75. So that's basically saying there's a very high risk that CDS is not going to work. And why is that? It references the reference obligation. In this case is unsecured. So that's a much smaller class. It's just over 600 to 700 million of unsecured debt versus billions you had in the secured class as deliverable. So one worked, it's TBD how the next one will work.
Yeah. I should point out as well, there was another Altice CDS credit event, which was for Altice Holding, the parent entity. That was deemed to be too illiquid to hold an auction, and so investors or protection holders were left to fend for themselves on that one. That's where you have to sort things out bilaterally with physical delivery. So that's the risk you have with not having an auction. But Orlando, perhaps maybe to this point, what do you think about the process? Does it seem like it was very improvised, or did they do that successfully? Or have we seen a sort of more arbitrary kind of outcome here?
I think my greater concerns are around we all acknowledge that single name credit default swaps play an important role in credit trading. The majority of my career, in contrast to my colleagues, my peers here, has been trading credit volatility rather than credit defaults. But ultimately, if the product doesn't work when it needs to, and if it is not predictable and consistent, then it's undermined. And I think we've seen that for over a decade now in multiple different areas. And we're getting to the point, started with Europcar, or that was certainly in the post-COVID 2020 era, of where the unpredictability had got to extremes. And I think with also a greater consciousness that not only are we seeing sponsors being much more aggressive towards their lenders, that lenders are being more aggressive to each other, and that the determination committee already has a misalignment of interest. They already have their own skin in their game. They have their own agenda. It is a dog-eat-dog world, and they are going to do what's best for them rather than what is independently and unbiased the best result or the fair result for CDS given the different mechanics. And I think once you lose that confidence, then you really undermine the market, which is unfortunate. We've seen a lot of other structural features. We have not seen the single name market adapt to new contracts, to new names that are being traded frequently. So we hear that both in Europe, but also in the US. There are certain names that have been put into the indices just in order to fill it out, but they're not trading, and we don't have the same transparency and consistency and liquidity in that. So we have what is a very important product that allows you to manage your credit portfolio in the ways that Clark and Nick were talking about. It allows you to put on a wide range of trades, as Mark was talking about, but our confidence in that has been undermined. So, and when you go to the end investors, this is where it gets really interesting. Then people do ultimately, pension funds, insurance companies, endowments are much less comfortable talking about credit derivatives, and that's not just bespoke and index tranches. That comes all the way down to single name CDS. And once you had the issues that were demonstrated by Hovanian, then we've slowly seen the market deteriorate and get to a point where it has shrunk to 10% of the size, that new contracts are not referencing the most actively traded companies in both the US and Europe, and where the product has become more niche and marginalised.
I think we will come back to the Hovanian kind of thing, because that sort of demonstrated an instance where a fix was produced after that with the narrowly tailored credit events. I want to keep on Altice just for now. I'm going to Mark's point about the result. Nick's point about the result actually being in line with what people expected. So there was that, and I guess the thought I've had from some people is that during the process, yes, using the ISDA lockup proposal didn't ultimately work, but I guess they would have learned quite a lot from that process by getting the feedback from the market. And maybe that will be a positive for going forward. It might be something they can work with. I think they found that it didn't really work very well for lockups and co-ops at the same time, but maybe there's some work to be done on that front, or at least they know it doesn't work. But Clark, maybe you've got some thoughts on how Altice went.
I was going to say, on the surface, it does look, for a better word, like a sensible process, but there is a lot of subtlety to most of these. An example is when I have a lot of CDS exposure, and if you were going into an event where there is a potential restructuring, timing is critical. And in this circumstance, it seems like there's the right intent. They've looked at this, they've delayed it a number of months because they thought they had to redo the systems or the processes of this restructuring from the CDS perspective. But be very clear, if someone has a position that rolls off in that 3-4 months period of delay, you don't get an event of default. So I would expect a lot of, let's say, risk had, for a better word, where people had protection, lost that protection whilst they were trying to ruminate and determine the process. So even though they ultimately had a nice, clean process, if they don't backdate that default, they have a view of the default at that point. And there's other situations here, but I would highlight when I have potential exposure on the CDS, and if it was into an event of default, 1 month to the next is massively different depending on when your CDS matures, because each of those is written and rolls, but once it's written, it has that set period of time. And people may not be familiar that, as it was with Altice, there's only 38 million that was actually delivered and settled. Where's the other billions work? Certainly it's been probably traded and, for a better word, cleaned out or settled beforehand. And if it was a far more earlier process, maybe it would be a different scenario.
So I think that what's going to happen is that there's been this sort of physical set. They've had to obviously deal with all the lockups and co-ops and come up with a process for that. So I think what's happening is there's been a physical settlement process where you have to say that you are not part of a lockup or part of a lockup. And then there's for the people that can't settle physically, then there's, after the restructuring, there's the asset package delivery for Altice, which will be after the 1st of October. So, but Nick, on that thought about the sort of economic recovery on CDS and the timing of it.
Yeah, the timing, yes.
Yeah, I think you had some thoughts on this, but about what's a fair kind of point to take the to take that value?
Yeah, there are two factors. One factor is from the day advisors were hired and the writing was on the wall, the SFR was restructuring. It took close to a year and a half for this to trigger. Now, part of that is just standard restructuring process. If a company is looking to right-size its balance sheet, fix its balance sheet, it holds on to liquidity and needs to get everyone organized. So just getting everyone, all the lenders organized can take time. We see that take without an imminent liquidity need, that itself can take a year, and probably base case does take a year in a lot of scenarios. And then beyond that, then you have this nuance of when does the DC call the trigger, which is another 3 months or so of slippage. Now, the problem is if you're an investor, you own CDS and you paid 20 points up front for the March date, and then suddenly it doesn't trigger until June, you just lost 20 points. So there's a lot at risk around timing. So getting timing right is critical. But I think the restructuring side of it, that should be understood from a fundamental credit underwriting standpoint in itself. And then we really need some improvement around the triggering process.
So I think the trigger was delayed a few months just because they tried to revise the process this time. So in other words, if they didn't try and revise the process, maybe the trigger would have been a few months earlier.
I think the point on timing is important because you did see the bonds trade down quite significantly. People have a need sometimes for cash to have liquidity. And if there's a big delay between when you're able to recover and recollect the cash if you need it, that's a bit of a challenge. So the time frame was certainly something I think that needs to be evaluated.
That's a really good point, because the second a restructuring's announced and suddenly official, the bonds trade down. Usually, in most cases, they trade down significantly. So that's the scenario where your debt, like in the case of SFR, debt traded down to 65 cents on the back of a restructuring. Did the CDS track it? The end result was probably okay, but at that time, you probably had a huge basis in the package between bonds and CDS. Just like you have right now in Altice International. Again, package should be tracking somewhere 95, 105, not 75, 80.
Yeah.
And the final thing I'd say, sorry, they did delay for a few months to put in this new process, and then they didn't even adopt that new process, which was a bit, why did they delay it if they didn't even adopt it? So those are the sort of questions I pose. I know there's a reason, but it's just a delay and then they don't use it.
Well, I guess one reason is that you don't know when the restructurings, if there's a timeline for the restructuring, but it may not happen. And there has been a precedent of this where they can get drawn out for a very long time. So you might get a lot of people waiting for that asset package delivery or for...
but in this circumstance, there was the restructuring and then they delayed it because they thought they had to do a new CDS process because people were private. That was a new process to them and they didn't adopt that ultimately.
For sure.
They did delay.
I think originally some people were keen for them to just wait for the restructuring to happen. And then I think the concern on that front was that what if Altice suddenly, for any reason, delays that, then they're going to look quite bad, I think, or people will be frustrated. So I think that's why they try to experiment with a new approach. But just on what we've learned from Altice, the other big thing that's come up about this is the inclusion of equity in the asset package delivery. Thoughts on that and what we're going to learn from that, especially as we're looking ahead to other credit events as well, where debt can be equitized and so on?
Equitization of debt is a standard means for correcting a balance sheet if a balance sheet's over levered. So it's just par for the course. That I get technically there's some investors who just can't take equity, but it's a classic tool in an LME or restructuring to right size. So I think it's par for the course. If you were CLO, cash CLO, you own loans, you're not on the co-op and you're told you're getting this equity, you are taking it, whether you like it or not. And then the question is, do you want to sell it for a zero value or do you want to try to trade out of it? But I think the asset package that's deliverable absolutely must include equity because that's the economic value of the bonds. When this Altice SFR bonds traded down to 65, that assumption was you would get some percentage of reinstated debt, whatever that, and at that time it was unknown. You could assume you get 60 cents, even it was much higher in the end, of reinstated debt and some percentage of equity. But that's still the new economic package of that old asset you owned. Any way you cut it, it's just 6 or half a dozen how you distribute equity versus debt.
But I think what needs to also be considered there, and I accept Nick's position and his approach on that, but Quinn Emanuel, when talking about LMEs, talk very much about the haves and have-nots. I think this increases the asymmetry of information and the flexibility between different players in our markets. And I think you have to accept that we're in a very multi-tiered world, and that's not everybody has access to the same information, not everybody has access to the same capital, they do not have the same flexibility that, as Nick mentioned. Many people are not able to own equity in their mandate, then the timing exacerbates these issues. So I think, yes, equity is the solution, but especially for CDS, and what this demonstrates more broadly across the credit markets is that we are dealing with a market that is multi-tiered and faceted, and you're not necessarily in a level playing field. And I think when considering the risk-adjusted returns or the symmetry of your payoff profile, if you are the minority investor, or if you do not have the same information as your competitors, then you really need to consider, can I get sufficient risk-adjusted returns from these investments? And I think that has changed a lot during all of our careers, and particularly with the proliferation of LMEs, and we're seeing that in single name CDS.
Do you think there's anything to be learned from I'll offer this up to anyone who wants to answer it, but do you think there's anything to be learned from the CLO landscape where they've been making moves to address this problem of receiving equity? Because I think old deals couldn't really do that, but there's been some regulatory changes on that front. Maybe, Nick, did you have some thoughts on that?
Yeah, look, I think we're seeing CLOs much quicker to sell, and sell at very low prices to avoid taking equity, or even a downgrade to triple C. The market's punishing those events much more than it had in the past. And it's just the CLO market managing a certain basket can only take so much, triple C can only take so much equity. And then suddenly, if you own several over-levered companies, 10 times levered businesses, they were 5 times when you bought them, now they're 10. To get them back down to 5 times, you need to haircut 50 cents of debt and take equity. And the CLOs are just much quicker to get out. I'd say in the past, CLOs would try to keep as much debt on the structure as possible in the form of PIK to keep a debt-like instrument, whereas long-term for the company, that's just delaying the inevitable. Like keeping an over-levered zombie company I don't think is the right outcome for companies, businesses, lenders, anyone. So there needs to be this forced deleveraging, balance sheet restructuring. And and then there's some people who want to play in that space and think there's a ton of opportunity. We think there's a ton of opportunity there, and others who just can't. So they get out and sell. Yeah, and that's okay. Selling is fine. The problem is if you own CDS and you own debt and you're forced to sell and your CDS didn't work, that's a bigger issue.
Yeah, I think you can't underestimate the mandate restrictions that prevent people from owning equity, and they might be forced sellers. So then the question becomes, is the intrinsic value of the CDS worth less?
Yeah, I think that's going to be an interesting one to look at. I think we should move on to Ardagh. I'm just conscious of time, but obviously equitization of debt is a key component of this discussion, because we essentially have a situation where I think to the outside observer, or even people who are been quite involved in restructurings and debt negotiations, to the outside it could look as if this is quite a consensual deal with 90% plus 95% plus consent, the SSNs, the SUNs, and quite a lot of the PICs on board as well. So at the moment, there's no obvious trigger for CDS. We've had a sort of early bird round. There may be more updates from the company on that. But yeah, there's a definite concern that CDS could end up paying out zero here. And it has been a really big component, I think, behind the scenes of this negotiation, which probably hasn't necessarily come out into the light for a lot of people. But yeah, we have this idea that it's going to be equitization, reinstatement of debt, and there could be no deliverables left to deliver. So also, even if there is a trigger, no deliverables, that could be a big problem. I think I'll start with Clark on this one. Is this the ultimate nightmare for CDS protection holders?
I would like to say, looks like a duck, sounds like a duck. You want it to be a duck. And in that context, looking at this situation with Ardagh, there's many elements that if you ask literally the man in the street and explain what a default was or what a restructuring was, and you went through the details, 99% would agree. So why isn't that the case? And in that context, let's look at that subtlety. But to start with, I think it's best to look at their Q2 report where through August they gave an update for the business. And this is where the company itself, in its half-yearly report, went into its detail. And what they did say about it, they said that the group, and they go through the numbers of support, etc., but entered into a comprehensive transaction support agreement, a TSA it's called. Now, this TSA, they've later called a tender, not a restructuring. Maybe it is, maybe it's not. What is the restructuring? But before we even get onto that, so as all parties agreed, and we'll go through those percentages, they give the numbers. There's 99% of the senior secureds, 99% of the senior unsecureds, and 82% of the PICs. So it's all been voted through. And even the PICs actually don't really have a vote or a say because they're effectively out the money, but still massive support for this. So on a motivation basis, people want this to be a restructuring. Then what it says is with all these parties, they've got certain terms agreed. And they include the significant deleveraging of the group, where they do the debt for equity swap. So for instance, all the senior unsecured notes, they get the vast majority, about 92.5% of the equity. And then the PIC holders get 7.5%. Now, this has been voted in by 99% of these people. So that is no longer bonds. This is no longer coupons. And in that sense, by most means, you'd think it's a trigger on a restructuring. On top of that, there's this element of, let's say, coerciveness. Now, you could call it an early bird fee or bonus, but as a perfect example, if you vote for the restructuring and you're the senior secured notes, you roll par. If you don't vote for it, you roll it 80 cents. In other words, the new security, you're either made whole or you get 80 cents. To me, that's quite coercive. Yes, they've got 99% support. So it's a good proposition, but that is, let's call it, has some bite. And the only reason, for instance, they don't view that as having bite is because they say it hasn't already restructured. So there's some unusual sort of sequencing that's happened here. But the essence is to say they don't think it's a restructuring event, despite, and you do need a certain level of support. If you have that level of support, that's one of the reasons it would be restructuring. You've got that. But they also say, and these are is it materially worse terms? It definitely is for the senior unsecureds. You don't have a bond anymore. So yes, it hits that. But then is it a binding agreement? Now, this is where there's less detail from the DC committee, because what is binding? I believe there's some senior bank holders, I'm not exactly sure, that could, for a better word, ride this process and stop it in some sense. But there's no motivation, and genuinely, even in the Q2 report, the company says they will effectively bankrupt the whole group if they don't proceed. So to me, it's very unlikely, if every party wants this to happen, that it doesn't. So if I just read the detail, for instance, on the DC language, they say that the DC determined that the reference entity has not made a general assignment, arrangement, or scheme. Now, if they're going to vote 99% for all these things, and for instance, even this last week, actually, there was two leading global investment banks had conferences. The Ardagh management was there. They were presenting Ardagh metal packaging and saying glasses have been restructured. They've gone to the community. Yeah, it has been presented as this. And yet the DC committee is saying that there's no scheme or arrangement. It is questionable. They say the thing is it hasn't come effective. Now, to me, when it becomes effective is when you have a majority voting. It's supported sanctioned by the courts if necessary. And it's certainly been made public, such as by management. To me, it's hit those marks. There doesn't need to be, I think, an out-of-court sanctioned process, so it doesn't need that court positioning, but certainly every element is there. So my question is, it had been an anonymous person that proposed this to be viewed as a default. It went to vote, and they said, look, it hasn't defaulted already, so by that definition, it hasn't defaulted. That's clear, but that's not the trigger for CDS default. It should be when there's this majority vote. It should be when there's actual genuine coercive elements if you don't exchange. It should be when. So I'm saying the man in the street would see this as default, and somehow the technicals have led to it not being a default. And to me, that is something wrong. Now, when it also was put to vote, it's interesting that one of the banks, actually a European base, did suggest it was a default, all these others didn't. But even when it was submitted for a vote, it was done anonymously. And that's because I expect there was some pressure not to put it to a vote, and it wasn't supported. That should be considered. Again, I think there might be delays. Maybe it's 6 months before the genuine trigger is viewed as a default. But through that 6 months, a lot of risk gets transferred. Those that had protections won't get the payouts that they should from what I view as a default scenario. So that's my little rant. And that's a weakness in this scenario, because they're suggesting you should fully restructure, because that's evidence of the restructure before it could be viewed as a default. Whereas I don't think that's the case.
Yeah, I think the early birds, it does seem to me that it crystallizes the ones who'll get better terms and the ones who don't get better terms. And we know who signed up to that within the time that they allowed.
99 support for all the voting members. So it's done.
Yeah, no, I think it comes down to, from talking to lawyers, I think it comes down to this idea of what's binding is one thing, and then what's effective is the next thing, which I think was, it might be slightly confusing the way that the DC worded its response on this, but as I understand it, dealing with things like schemes, they may not happen. That's the idea. And in this case, the restructuring or the equitization may not go ahead if Ardagh decides not to. So I think
and this is despite having 99% support of the actual new equity holders that management have already said have now controlled the business. Yes.
So I'm not clear either that the DC actually considered the early bird announcement, because the question that was asked about it didn't include that as evidence. But I'm not sure also that it would make a difference. That's the key thing. But
it is a sequencing issue. They're literally saying it has to default in and complete the restructuring for them to have evidence of it happening. Whereas I think the evidence is quite clear a lot earlier. And this is where I think the CDS as a product can improve, because I wouldn't want my CDS as an insurance in this particular company simply because you're not going to get paid until they choose it's the right time to pay. They can delay it 6 months, clear their risks, and then they get paid. And that's my concern.
Well, that's the other thing. I think this thing could run till the end of the year as well. So there's a September expiry, there's a December expiry of CDS contracts that may run off in that time. So again, what do we think about this, the sort of process to get there? Is there anyone else think there needs an overhaul on this aspect?
Yeah, I'd say in the interest of time, since we're coming up on only a few minutes left in the hour, and then we want some Q&A maybe. I think to wrap this, there's really two questions that are remaining. Is single name CDS viable? And what is the determinations committee role in making this better? I'd say that we've had challenges with consistency and predictability in this asset class for a while. And I think the reason why it's trading so little in single name is because fool me once, fool me twice, and people are finding out that every time they go to hedge or protect themselves, they find out that it doesn't exactly work as intended. And this is not new. I remember being back around the time of the global financial crisis where I'd put on a trade, thought that we were going to make a boatload of money. And then when we went to unwind, the counterparty said, oh, your recovery assumptions are changed. It's not the same as you entered into. And so now we have all of these LMEs, timing issues, dead boxes, drawn out restructurings. And so I think looking at single name volumes, I'm just going to throw some stats here from the DTCC. It's only 26 entities actually trade with any meaningful daily volume in the latest quarter, 13 sovereign and 13 non-sovereign. In the Americas in second quarter, there were 292 names that actively traded with an average daily volume of only 11 million a day. That's minuscule. And only 17 names traded greater than 25 million a day. In Europe, it was a little bit better, 252 names, but only 47 traded greater than 25 a day. Contrast that with index, and you're looking at a mosquito next to an elephant. It's 50 times the size. So I guess as we bring this to a close, and not just griping about all of the challenges that have happened in the past, how do we get this right going forward? What does the investment committee need to do? Or do we just accept that this is an imperfect hedge and it's just a sentiment indicator and no longer something where you can calculate a mathematical recovery? And I know, Clark, you've been involved a lot with the determinations committee, so maybe you have some views on that.
It's not an easy solution. I think we all agree there. I would suggest, of recent times, there's a governance committee that's been introduced that hopefully may come with some resolution. But I think the evidence speaks for itself, and that is it's not working as it should. And it's then a question of how do we make it work per se, because I don't have a proper legal background and there's always a wriggle, there's always a little hole there that you can work. But the key principles should be clear and abided by. And then where there is a default, as it is here, 100% of the bonds becoming equity, that would be viewed, as it often should be, as a default.
And I think it's important to recognise that credit is already a less efficient market. Europe's less efficient than US. High yield is less efficient than investment grade. And all of this undermines the efficiency of the market. So we were getting to a place where you could construct your portfolio, you could hedge in a wide range of different ways, and that's actually reducing over this period. So I think that leads to more expensive pricing for companies. It leads to less efficiency and less consistency in the markets.
One idea is there's a lot of time spent by rating agencies in how they view a default. And obviously the whole coercive element, they often view a default quite early in the process. Maybe it's a third party like the rating agencies that actually become the standard bearer as to what a default is that should trigger this, as opposed to, let's say, a sell side community maybe funded somewhat with some lawyer participation.
Clark, that's a really good point. The rating agencies have pivoted over time to start to include LMEs in defaults because we know economically something like Ardagh, these bonds, let's say they're trading at 50 cents, but the asset trades at 50 cents. So theory, you had a default where you lost 50 points and it's just not triggering. Look, part of the reason is this 90% threshold. We cross 90% of debt and then it's a voluntary change of money terms. It doesn't trigger CDS. Like, I think that one, that needs to go. I think two, equity needs to be delivered because Ardagh, those bonds are trading and they are, call it, quoted 50 cents. That's $1 billion value worth of equity there that someone should take delivery on. If they want to then go sell it, they can sell it. But I think not being able to deliver that equity and creating a dead box on something that's trading economically at 50, it just needs to change. And look, the DC generally, I've seen my history is they look at the rule, the letter of the law, and they tend to go by it. And right here, in this case, the letter of the law is if you have over 90% accept, then there's no forced change in money terms. So there's no trigger. That needs to somehow be rethought.
So just looking at possible solutions, obviously, I think Clark mentioned there is the ISDA initiative to overhaul the DCs to look at external or independent membership, or to have this governance committee overseeing it, and to look at who pays for the DCs, things like that as well. So that is going on in the background. I don't know how long that will take to play out. I think the question of who pays for it is going to be the thing that kind of extends the timeline. But what about other solutions for CDS? I mentioned before about Hovnanian with the narrowly tailored credit event fix that happened after that. Obviously, we had the financial CDS fixes that happened after government intervention and bail-ins, which we haven't seen in corporate CDS yet. Is there a comparable solution we could have for corporate CDS? And
I also think you need to look through to the underlyings, right? The underlying instrument and what constitutes a default. Maybe we need stronger indentures and we need to figure that out as well. I think on the CDS side, timing is also a critical issue.
I think that's obviously a good point, that part of the market is evolving, and keeping up with the changes in LMEs and things like that is a really difficult job for anyone to do, let alone the DCs. But what do we think about this? Like having some kind of like an asset package delivery. Why can't we just say, for instance, in the case of Ardagh, whatever the exchange value is into equity, then that's going to determine your recovery on the CDS. Nick, do you have any thoughts on that?
Yeah, look, I think there's a little bit of it. This is very difficult thing to actually put in writing, but there's letter of the law and there's spirit of the law. And we've seen so many times where the DC knows and accepts this isn't within the spirit of the contract, but we found another problem because the market has morphed or changed, or LME processes have changed. But I think a very independent committee with lawyers, just like you were going to a court in bankruptcy, stating this is what the contract was meant to do, and making that work. Now, I think that is, again, delivering whatever the package is that you owned needs to be more, the contract needs to be more flexible. The problem is the market has been, or the DC and the structuring of the contract has tried to avoid inadvertent triggers. And if anything, it's gone the other way so far. It's made the products in not really viable. So I think leaning towards triggering easier, especially in a place like Europe where you have a scheme, but it doesn't actually trigger till the papers are filed at the court. So, but we knew the scheme was happening. It's already been agreed. So maybe it's like upon agreement of an RSA, TSA, then that's the trigger.
Yeah.
Needs to be more flexible to be able to trigger.
So we actually had one question in the chat, but it's actually on that exact point about asset package delivery for these situations. So I feel like you might have answered that already. I guess the other thing conceptually, people maybe who are not so used to CDS might think is like, why can't you just have a fixed recovery on CDS that pays out a set amount on default? But I guess the answer to that is that it then won't replicate the flows, the Z spreads of bonds, and it won't be a natural kind of hedge against bonds or trading instrument.
And it still might not trigger.
Yeah.
I guess there's been a development also of some parallel markets like the total return swap market or TRS market, which in principle is very similar to a CDS, which is contract for difference essentially. Now with the total return swap, some of the key characteristics there is usually it's a 1 or 3 month. There is a reason for being. Usually it's directly with a bank that you're facing. And why the bank are motivated to do it is because even though they give out the earning income, the collateral is still registered for the TR1, etc., capital provisioning in the bank's capital sheet. So they actually get the benefit of their capitalization, yet can still sell the product per se and the earnings income. But they do, usually typically it's 3 months, it's one counterparty. And in that time period, it's far easier to see what's going to happen. I guess one of the challenges with the CDS is you've got a 5-year or a 10-year. A lot can change in that period of time. So we're seasoning in a sense and looking a long way ahead with the current CDS contracts.
I think that TRS angle is very interesting, and I believe it covers a vast part of the market as well. So it could be one to look at. On keeping with saving CDS as a viable product, maybe Orlando and Mark, just to wrap things up, we haven't had any other questions yet, but if you do have questions, please send them in. We'll answer them.
I think investors want it to work out. Right.
Yeah.
I think if people need to be on the other side of the trade, it has to be fair for everyone. And I think the scaffolding is there. It just needs to be bolstered, and it could become a more viable product again.
I think we need consistency across the market. So as we've seen covenant light proliferate from 0 in 2008 in the leveraged loan market to almost 90% today, as we've seen the technology used in LMEs change, develop, and proliferate, we have to have contracts that are consistent with what's going on in the underlying markets. We need to have that structural, kind of robust structure so that we don't have aberrations in different parts of the capital structure. We're looking for that. Personally, part of our alpha is looking at those inconsistencies, and I think making things more niche does potentially add alpha, but it also reduces efficiency and it reduces the number of use cases for those products, which undermines the overall quality and strength of the market.
Yeah, I mean, I think I agree with your point that this does raise opportunities for a select group of people, right? But it's how we get back to that flow trading product. Is that kind of the end goal? We want to get that back, get more volume through CDS, more people. Will that in itself, if we get momentum going in that, will it help solve the problem?
Yeah, I'm all for a strong and healthy market, and in that sense, we should also put in context too. 99% of the time, these companies perform, and these questions aren't raised. It's that 1% where it is very difficult and there's a restructuring. And I would highlight that there's similar issues when it comes to even equities or bonds, and pretty much every instrument when they actually come to a credit event or restructuring. That's the key challenge. But ultimately, I think it's a very good product as a performing product.
Great. So I know we're just over time, but I think we have one more question that's coming on the chat. It says, what's the view from the group on the trigger question when consent solicitation begins at Ardagh? Who wants to take that one on?
I can say what I said a little bit earlier. Consent solicitation has already gone through. They've got 99% of senior secured notes, 99% of senior unsecured. So I think that's already been done, is the answer to that. It's a question. They don't view that as the agreement because there is some, for a better word, weakness in the language or the process. That means that it isn't a definitive process and there is a risk that it doesn't complete. But it's very unclear where that risk is, to be honest. And that's the concern and the highlight of the issue there.
Okay. Unless anyone else has got any final thoughts, I think we can wrap it up there. And it's been a great chat, and I was really excited to do this today. And it's been all I hoped for as well. So thank you so much, guys. I really enjoyed that. And yeah, as I said, anyone who has questions, please follow up with us, get in touch, and we will put together some example pieces, I think, in the coming days or to go along with the replay. And yeah, that will be available through 9fin.
Thanks a lot, Dan.
Thank you, everyone.
Thank you, everyone.